can begin with our next session. Requesting all our wonderful delegates, please to settle down so that we can begin our session. All right, ladies and gentlemen, let's move on to factor investing, the emerging trend. Well, our next speaker will share key insights into how factor-based investing is evolving and how investors can harness specific factors to generate better returns or manage risks. Once again, requesting all our delegates to please settle down. Well, I would like to invite our speaker who brings over 14 years of experience in the financial industry. Well, a qualified chartered accountant, he has focused much of his career on passive and hybrid products, including index funds, ETFs, and multi-asset funds. Outside his professional life, he has a genuine love for reading, which he credits with broadening his perspectives and enriching his approach to both work and life. Ladies and gentlemen, please put your hands together for Mr. Ankit Singhania, Senior Vice President, Head Passive Strategies at UTI Mutual Fund. Welcome, sir.
Good morning, everyone. So, I have been given a very interesting topic on factors investing, which we also call as smart beta. Now, in this 15 minutes, what we'll try and understand is the strategy smart? Are the investors smart for investing in it? And if the strategy is smart, how smart it is, and how smartly we can use it. Right? To start with, we'll start with the broader perspective of MF industry and how this category has evolved, and then we'll go deep dive into this factor-based or smart beta investing. Now, to start with, let's understand that there are two broad investment philosophies that exist in the MF industry. One is active and the passive. And if you know, the entire debate always keeps on running between active and passive, whether active is good or passive is good. And we always say that it is not about active or passive, it is always about active and passive. Because both of these investment philosophies have their own set of advantages and challenges. Talking about actively managed strategies, why they are so popular is that they are alpha generating strategies, whereas the risk that they run is that the entire thing is discretionary in the nature. Within the defined categories, fund manager basis his discretion, takes a calculated risk, makes an understanding of the market, creates a portfolio, and if that discretion goes right, there is alpha, and if sometimes that discretion goes wrong, we also see there are chances of negative alpha or no return. So that's the challenge that actively managed strategies poses. When we talk about passive strategies, in case of passive, there is no discretion that is being involved. In case of passive, what is generally done is that we take a market cap based index or any market index and simply try to replicate the performance of that index. So the idea is not to take any calculated risk, any discretionary risk. The idea is to just rely on the collective wisdom of the market. But the challenge it poses is that there is no alpha. Right? When you are investing in Nifty 50 index fund, you cannot expect any alpha because I am investing in the same 50 stocks in the same proportion, so there cannot be any alpha. Now, in case of active and passive, there are advantages and there are challenges, but thinking from an investor perspective, what he wants is the best of both the world, best of active and best of passive, and to kind of bring that to our investors, cater to our investors. A new category that has emerged is factor-based investing or factor-based passive investing, in which it actually combines the advantage of both active and passive in the manner that it actually generates alpha. At the same time, there is no discretion that is being applied, right? When we say there is no discretion being applied, which means that there are factor-based indices that have been constructed. Now, since it is a factor-based index, there is no discretion that is being applied. At the same time, the index construction itself done in a manner that it has a tendency to generate alpha over broad indices, right? So this is how factor-based or smart beta strategies have emerged, a combination of advantages of both active and passive. Now, as a category overall passive, we all know that this industry has grown leaps and bounds, right, from 2015, where the total assets in passive industry was roughly 14,000 crore, to currently it is close to 11 lakh crore. So this is the kind of growth this entire passive industry has seen. But within passive, if we are talking about factor-based investing, this category, the factor-based investing, has emerged in last 3 years. So if we actually go and check the growth of factor-based investing simply in last 3 years, right? While the overall passives have grown by say 34%, 38% CAGR, the equity-based products have grown by 34% CAGR, but the factor-based strategies have seen a whooping growth of 101% CAGR. If you see, it is actually from 200 crore to now 24,000 crores in approximately 4-year time. Now, this kind of growth is a reflective of what the performance is actually presenting in case of factor-based strategies and the kind of adaptability investors across the board are taking with respect to these smart beta funds, right? So you can see from 236 crores to close to 24,000 crores, which is 218% CAGR and 101x in 4 years time, right? In 4 years time, and that is a whooping number. Now, to understand it better, if we go and check the various smart beta strategies that are available in the market, popularly, if you ask me, popularly in the Indian markets and also in the global markets, there are 5 strategies that are available in the factor-based space, which is momentum, low volatility, alpha, quality, and value. Now, these strategies have their own construction method, their own advantages, and their own challenges, like any other strategy. Now, I will also segregate these factor-based strategies into 2 categories. The first category is price-based strategy, and the second is fundamental strategy. Now, if you ask me, the 3 top ones, momentum, low volatility, and alpha, are price-based strategies because the construction, the selection of stock in these strategies are actually based on the price behavior of the stock or the price movement of the stock. To start with momentum, if you see, momentum is what? Momentum is an investment philosophy which says that the stocks which have done well in the recent past will continue to do well in the recent future, and in that process we try to capture the current momentum of the market, right? So that is what momentum philosophy does. It tries to capture the stocks which are currently in momentum and creates a portfolio. To give you an example of momentum, there is an index called Nifty 200 Momentum 30 Index, which out of 200 companies from large and mid cap identifies 30 stocks on the basis of their momentum score that they have generated in last 6 months and last 12 months and creates a portfolio of 30 stocks. That is what momentum does. If I talk about the second strategy, low volatility is a strategy that actually identifies and picks stocks which are lesser on volatility, having low standard deviation. The idea is to pick relatively stable companies within the universe. So in that space, if I take an example, there is an index called BSE Low Volatility Index, which out of BSE 200 companies picks 30 stocks on the basis of their lowest standard deviation for last 252 working days, which is technically 1 year. So that is what low volatility. Idea is to capture relatively stable companies. The third is alpha. Now when we say alpha, it is a very known term. Alpha is basically the better risk-adjusted return to generate over a period of time. So alpha, in case of alpha factor, the idea is to pick stocks which are high on Jensen alpha for last 1 year. When I say Jensen alpha, in simple language we can call it risk-adjusted return. So it is basically high on Jensen alpha for last 1 year. So these are 3 price-based factors. If I talk about the fundamental factors, the 2 fundamental factors that are available is quality and value. Now, when I say fundamental, which means the stocks are selected on the basis of their fundamental attributes and not by their price behavior. To start with, if I talk about quality, the idea is to invest into quality companies. Now, how we define quality? See, quality can be defined in various terms, but the way it has been designed is that it actually sees the company's current profitability, which is ROE, current stability of the balance sheet, which is measured in the form of debt to equity ratio or financial leverage, and the EPS growth variability, which is nothing but the consistency of companies earning to generate earnings year on year. So EPS growth variability for 5 years. So this is how these filters apply and actually computes quality score of the stock and pick quality companies. The fifth factor or the second fundamental factor is value, where the idea is to pick stocks which are currently trading below their intrinsic value. Now, for example, if the actual value of the stock is 10 and currently it is trading at 7 rupees, which means there is an intrinsic value of 3 rupees, and the moment it will only get its value will generate returns, right? So that is how value investing approach works. Idea to identify companies which are currently trading their intrinsic value. So these are broad-based factors that are available in the Indian market and also the global markets. Now, having discussed about the factors, the first thing that comes to our mind is that why we need factors at all in the first place. Is there any merit of actually using factors in our portfolio? Now, to answer this, let's see the long-term performance of all these factors. Like when I see the long-term performance for last 19 years, the index data is available from 2005. If you go and check from April 2005 till say February 28, 2025, almost 19 and a half years, what you can actually see is that on a long-term basis, if we see the comparison of Nifty 50, Nifty 200, which are broad-based indices, all these factors have generated close to 5 to 6% alpha against these broad indices. Which means why these factors are needed, because in long term all these factors tend to generate good alpha. If I say 3 to 4% alpha is also a good alpha, whereas in this we can actually see that some of the strategies have generated roughly 5 to 6% kind of alpha. So factors do generate alpha against broad indices in long term. Now once we see long term, say 19 years, the question comes in my investment may not be for 19 years, right? What is the general trend? What is the general trend of these factors? To answer that, if we go and check the financial year wise return of these factors, there may be a lot of data, so I'll again summarize it for easy understanding, is that we have highlighted something green, which actually shows that in each financial year, what is the factor that has outperformed all the other factors and the broad indices. So you can actually see that the performance trend of all these factors keep on changing. Like in the current financial year, quality is the best performing factor, while the previous year or the 2022 or 23 again, value was the best performing factor. So the performance trend of these factors keeps on changing, and if we go and simply check the summary of this, you can actually see that FYTD 2025 quality is the best performing factor. Before that, value, again alpha, value, quality, alpha. So the performance trend of all these factors keeps on changing. Now the biggest question that comes to our mind, especially in the recent performance when all these factors are underperforming, is that how to actually assess that what factor to consider and at what point of time. For this, what we have done is we have done a small analysis to show that what is the performance trend of all these factors across different return periods. For that, what we have simply done is we have computed Nifty 200 1-year daily rolling return for last 19 plus years. The idea of taking Nifty 200 is because all these factors, the universe is largely Nifty 200. And that's why to understand the behavior of the market, what we have actually computed is Nifty 200 1-year daily rolling returns. After computing Nifty 200 1-year daily rolling returns, there are close to 4,700 kind of observations. We have bucketed those observations in different return ranges, like whenever Nifty 200 in a 1-year period has delivered less than minus 10% returns, when it has delivered between minus 10 to 0, between 0 to 10, between 10 to 20. Likewise, we have bucketed all the return simulations that we have done. Now, when we have done all of that, we have found some observation with respect to all these market behavior, all these return periods. Now, if we simply go and check the alpha that all these factors have generated across different return phases, what we can actually see is momentum as a strategy has generated alpha across all market conditions. That alpha may be 3.5%, 4%. In a aggressive market, that alpha increases, but momentum is a strategy that has generated alpha across all market conditions. Now, if we go and check For low volatility and quality, they are a strategy that generates alpha in bearish market, flat market. In an aggressive market, they do not generally generate alpha. While if I talk about value, value is a strategy that generates alpha only in very aggressive market. You can actually see that it generates alpha in between 20 to 30% or above 30% only, and that alpha is close to 17%, 24%, right? So that is how value generally delivers. To summarize this again, what we have done is simply a general factor behavior. Is in a bearish market, what performs is quality, low volatility. In a moderate uptrend, what performs is momentum, alpha, value. And in a very strong market, what performs is value, momentum, and alpha in the respective order. So this is how, basis your understanding, basis the trend behavior that you analyze about the market, you can actually create a portfolio of these factors. Now, one important thing is that what we need to understand is the consistency of performance, right? While the long-term performance is good, while in different markets, different factors perform or outperform each other, what we actually want to understand is what is the consistency of these factors. Now, to check the consistency test of these factors, what we have done is we have simply calculated 5-year daily rolling return for all the factors and compared it with broad indices like Nifty 50 and Nifty 200. And this is daily rolling return of 5 year, right? And you can actually see that on the basis of 5-year daily rolling return, on an average return basis, all these factors have generated alpha against broad indices. That is one thing. The second important thing to note is that what is the percentage of time these factors have outperformed say Nifty 50 or Nifty 200. Let's for understanding consider it only a comparison against Nifty 200. So if I talk about momentum, momentum on a 5-year daily rolling return has outperformed Nifty 200 99% times. That's as good as 100% times. While the outperformance is 99% times, the average alpha that it has generated is close to 6%. Average alpha against Nifty 200, right? If you go and check low volatility has also outperformed Nifty 200 roughly 96% times, and that is also as good as say 100% times. The alpha is still close to 5% times, right? While if you talk about value as a factor is outperformed only 40% times, where the average outperformance is 8.8, which means if you actually want to time a fundamental factor like value, you need to enter at right point of time and exit at right point of time. However, if you consider factors like a momentum, low volatility, or a combination of momentum and low volatility, with a 5-year investment horizon, the probability of you generating better returns than Nifty 50 is as good as 100%. So that is how factors can be used in long term, that with disciplined, defined investing process, with no discretion being taken in the overall process because these are defined market indices, what you can actually generate is close to 6% kind of alpha with a 100% probability of beating the broader indices. And just last before ending is that return is only one part of the story, right? The another part of the story is risk, right? And that is why it is very important to see what is the beta that all these factors carry, and especially in a 5-year investment horizon. So when we see the 5-year investment horizon, which is the bottom column, you can actually see in a 5-year period, the kind of beta that factors carry, in fact, especially momentum or for that matter, low volatility, quality, value, all of that is as good as closer to Nifty. In fact, momentum is having a beta of less than 1, whereas quality, low volatility is having a beta of 0.64, 0.75. So it is not that they are generating returns, which means they are carrying a higher beta. The beta is also well within the limits if we compare the behavior of all these factors. So what we are talking about is a good alpha, 4-5% kind of an alpha with beta as good as Nifty 50 or even lesser than Nifty 50 is what smart beta offers. Now I leave that to you, that whether the factors are smart, the strategies are smart, or the investors are smart who are actually reflecting that kind of growth of 101x in 4 years. Thank you. My time is up. Thank you.